Welcome back, guys, to another episode of Asheville Real Estate News. Today, we are going to be talking about running numbers for rental property. What we're doing is getting joined by Keith Prescott. He's a local broker here at KW. He was on the show a couple weeks ago, and we actually run through the numbers for two properties here in Buncombe County, talk about whether they make sense or not. We also have a little bit of a conversation on what numbers are important, what you should consider, is it true or not that there's no such thing as bad tenants, only lazy landlords, and a couple of other things that just get into the numeric side of rentals and a little bit of thought process and mindset around it. As always, this episode and all of our episodes are sponsored by and brought to you by American IRA, your local IRA custodian. So without further ado, hope you guys enjoy the show. Reach out to Keith, let him know what you guys think, and don't forget to share this episode with your friends. All right, Keith, welcome to the show. Glad to have you back on. Really excited about getting into the numbers today.
Yeah.
Just for the people who didn't listen to our first episode that we did together, can you give a quick 30-second recap of what we talked about then and why we're talking again now?
Yeah, absolutely. We had a mutual friend, and I'd meet a few times. You said, come on in, let's talk about personal finance. I want to have someone on. Mm-hmm. I'm super passionate about it. And so we discussed, how do you handle your money? How do you pay debt? How do you do investments? Things like that. And I said, it'd be fun to run numbers on a rental property so that people that don't understand how to do that, or maybe they think they do and they might be making a few minor mistakes without knowing it, we might be able to clear a few things up and let them know how an investor does look at properties for cash flow and total return and stuff like that.
Yeah, I also want to chip in that I don't even remember if it was on camera, off camera when we were talking. Yeah. There's some different, I think it's interesting that there's a different perspective and there's a lot of different approaches to run numbers, right? And so, although what today we're going to discuss is probably going to be a really good starting point, I think as a reminder to people, as you go through this, you're going to find certain systems or tweaks that do make sense to you because there are a lot of variables and it's important to don't box yourself in by accident.
Yeah.
Box yourself in on purpose. Once you know what your rules are, then you want to adhere to them, but don't just follow rules without knowing them. I would say, I don't know if you agree with that.
Yeah, I think that if you're going to build a house, the best way is have a solid foundation and framework, but the roof you choose is your own, the paint, the siding. Yeah. You've got to figure out, you've got to flesh it out yourself, but the experience will teach you that, but try to have a foundation to build off of. And if you can lean on mentors and coaches and people who have done it before, you'll be able to kind of, my own system's morphed from what I've been taught.
So. Yeah, so your system's different today than it was whenever you started. Yeah. So with that, let's get into it. Let's get into the numbers. So laying some groundwork. These numbers are for rental property. So this is not a flip. This is not a short term. We are looking at buying something and how to determine if the cash flow on it is worth it. So what do you got for us?
Yeah, so when it comes to if you're going to do buy and hold long term, even if you want to do short-term or something, my point of view is you want to make sure it works long-term because heaven forbid a city law change or something like that and you can't short-term it.
Yeah.
Now you're stuck with a property that's not profitable anymore because you ran the numbers on a higher profit. Anyway, so I always aim long-term first. If short-term makes me more money, it's a bonus.
Yeah.
So I was looking through Buncombe County, and a very strange thing about Buncombe County is because the prices here are so high, the only properties that really make sense for a buy and hold long-term property more often than not turn out to be double wides.
Or single wides.
Or single wides.
If you've listened to the show, I'm a big believer, big fan of mobile homes, single wide, double wides in general. So
absolutely.
So you brought some properties in. So let's take a look at those. And like you said, these are all double wides, right?
I was trying to find some concept. And it was either you could find a house at a reasonable price, but it needed so much work that I couldn't sit there in a few minutes and tell you what my estimate repair value were. So I was just looking for cosmetic stuff that I can generally tell you what I would expect that to cost, and we can kind of get into it.
Awesome.
The first one, and these are all, I believe I got 3 actives. I did. So all of these are available on the market. If someone's listening in and they're like, oh, that's interesting to me. I want to look into it.
So today is the 15th of November. So you know, this
is
nice this is November 15th, 2019. So this is what's available. So let's get into it. What's the first one?
Excellent. So this one, in no particular order, but it's the lowest price one, so we'll start there, It's a $100,000 list price. And now when I run my numbers, I say this up front just to give people a perspective of the pool we're playing in, but I don't care. That is the last number I think about when I run numbers on a property.
Which number?
What they're asking.
So asking price is irrelevant.
To me, it's irrelevant when I'm running numbers on a property. It's the last thing I look at. I said it first just to give someone an idea, but the next two I'm not going to mention it. I'll say it at the end.
Sounds good.
Because a home is worth what I'm willing to pay for it and the seller's willing to sell it for. What they're asking might not necessarily be what they're willing to accept. So we want to run our numbers first, and then you want to look at, well, where does it make sense for me to purchase it? And then you look at and see if you're close, or even if you're not, make an offer.
Right.
Can't hurt. First thing I want to do is I want to look at, okay, this one is a 2,000 square foot. It's 2,000 square feet. It's built in 2000, so right off the bat, I know it's a more modern build. The standards of mobile homes really jumped up after 1976, and they jumped up even more in the mid-90s. And after 1996, you can't use polybutylene plumbing, and polybutylene plumbing can be a problem. So generally, if you find it, you typically are trying to replace it. So it's a cost you have to kind of calculate in there. So no poly, 2,000 square foot house. It's a 3-bed, 2-bath. It's in Leicester, North Carolina. It's 10 North Coyote Spring Farm Road. This one's out there. It's sitting on an acre. It has a little view to it. Location's not ideal. You're a little bit further out from the city than I normally would like to go for. Interesting enough, they write in the remarks that it has a 3-bedroom septic, but it's being used as a 4-bedroom. And so as a landlord, that's your choice.
Yeah.
Be aware that that's your choice, but there are risks. Just be aware. So I'm just going to assume this is a 3-bedroom so we can just keep it simple. Right off the bat, I'm going to say I should be able to get out there, what would you say, in Leicester? I'm guessing somewhere from $1,500 to $2,000 a month. I'd
probably be running it closer to that 1,500 mark, because I'd want to be conservative.
Perfect. Then that's what we're going to do.
Because of the distance.
We're going to run off an assumption of the rental gross every month is $1,500.
Yep.
Now, you're going to want to take away from the gross your vacancy, which means people move, or you have a tenant problem and they can't make rent and they're going to leave. But typically vacancy is something you put in, and what you'll find is an industry standard is typically 5%. Personally, I've seen it more towards a 2-3% line, but that's because I've gotten really good at spotting someone who's getting ready to leave, lining up all the subs to turn over quickly, and having it advertised ahead of time.
Yeah, and I mean, talking about numbers, I typically never take into account vacancy.
Yeah.
So
and people are different. Exactly.
Right. And I mean, probably should. I just never have.
Yeah, that's fine. And the whole thing is, I like doing, they call them accounting errors.
Yeah.
If I'm going to round off or make an assumption, if it's going to cost me something, I round it up. If I'm going to make it, I round it down. So that accounting error is always falling in my favor. That's always a goal. So if you assume a 5% vacancy rate, that's $75. So we're taking 5% of the $1,500. It's pretty easy. You move the decimal point over and cut it in half. 75. Now, as far as repair costs go, if this is a home that I'm going to buy and then go in and fix up, I'm going to put new floorings in, new appliances, new countertops, new paint, and I know the roof is in good shape, and I know the hot water. If I know the big systems are in good shape and I've done the work, I don't think I'm going to have a massive repair bill, but I still like to go with 10%. There's a difference between repairs when you're managing, if you go to the technical guys, you go online, they're going to talk about CapEx, which is capital expenditures, stuff like a new hot water heater, a new roof. There's the big
HVAC system,
big ticket items that come up every few decades. Repairs are having the toilet unclogged, painting, replacing some carpet, just general kind of turnover stuff. But in general, I like to just use a 10% overview on that whole thing between repairs and CapEx, because generally I'm fixing up these homes before I go in. So I'm looking at 10% there. That's $150. So if you take all that out, 150 minus 225 of 5, 1275, if my math is correct, is what I would expect that I will use as my gross income coming. Yeah, my new income to work off of. Now what I need to know is how much is my property tax a year broken down by month. On a home like this, I'm willing to bet the assessment's under $100,000. Let's just call it $500. for simplicity,
Okay,
or $600 for simplicity's sake.
Okay.
So that's going to be 50 bucks a month.
Yep.
So I have to pay that tax. Let's say the insurance is the exact same thing. It's another 50 bucks a month. So now I'm down to $11.75.
Mm-hmm. Following so far, yep.
Yep. And really, it can be as simple as that, depending. Now, if I'm going to pay cash for this whole thing, it's a whole different makeup than if I'm going to leverage it.
Well, let's assume you're leveraging it. I mean, I don't think that there's a ton of people right now, even if they could pay cash, that they would pay cash.
With the interest rates so low.
Right. So let's just assume that you're going to have debt service.
Yep. And typically, if you want to avoid, I mean, if you can get private money, it's a whole different thing. But we're just going to assume that the general person watching can go to a bank, can get a loan on a 30-year fixed with 20% down for an investment property.
Okay.
Now, the way the banks will look at this, and I didn't mention this because I'm on the fence on it, 10% property management gross.
Always charge it.
You should put it in your projections, because while you may manage it yourself and not pay it, one day you might want to.
100%. I think you should. Yeah, you should always account for it, because even if you're self-managing, I agree. If you're thinking of doing this for scale, you can't scale and self-manage 50 or 100 doors by yourself, or even 20 you might not want to. So whatever the case may be, plan for it ahead of time.
Yeah. And this is, I always thought every property manager would take gross. Mm-hmm. That would be 10% of the gross, and I didn't like that. Because then if the repair costs go too high, or if they're overpaying for repairs, they have no skin in that game. I always searching for a property manager who's on the net side of the table, which is net is the owner side of the table.
Right.
And I found one. And that is something I think people should search out for, is if you can find a property manager who takes their fee off the net, and if they have a good reputation.
Well, are you going to share this information with us?
Her name is Anna Connor, and her company's name is Rent828.
Okay.
She's fantastic. If I have a question on what I think a property's going to rent for, that's who I call. I call her immediately. We're having lunch next week. I mean, she is a fantastic person. I do not use her personally, because right now I manage all my own stuff. If one day I want someone to manage it, I would not want anyone but her to manage it for me.
Heard. So management's going to be another what?
10%.
10% off of the gross rent, though. So the $1,500, right?
Exactly.
So we're talking about another $150.
Another 150. Okay. So we can come down and we're sitting at $1,025 is where you're going to be. Mm-hmm. Now, when you go to a bank and you go to buy an investment, or if you're going to buy the next home and keep your old home and rent it out, what they do is whatever the lease that you're going to get on it, they credit you 75% of that as income. So that kind of lines up, because you got 5% for vacancy, 10% for repairs, and 10% for property management. There's your 25%. So that's what they'll credit you. That's something that's kind of a good thing to think of as a rule of thumb. If banks are going to use a 25% expense ratio, it's not bad for you to use it either.
Right.
With that being said, now we're down to the 1025 after tax, insurance, and all that stuff. Now, if I look at this and I think to myself, okay, that's what I'm going to be making, but I'm going to be borrowing the money, and this is where we get into the borrowing money.
Well, your mortgage is going to be another at least $500, $600 there, right?
Right now, at the interest rate's about $500 gets you $100,000. So when you get into the leverage part of things, yes, you are going to want to know what you're willing to pay, and the list price kind of starts coming in when you're talking loan-wise, because that's going to factor in how much you're borrowing. But let's just say that you're going to borrow it. 120 is what you're looking all in to purchase the home for. This home is 100, so we'll just use 100 because it makes it easy. So we're going to leverage 80. That's going to put your payment around, say, 400 a month. Okay. Now you have the 50 taxes and insurance, but we've already covered that. So we're looking at 400 in debt service. So you're at 625. Now the input I'm going to put in is I got to put down $16,000 for down, $20,000 down for down payment on a $100,000 purchase. I'm doing 20%, so I'm in 20 grand. You got to add in attorney's fees, and maybe you're going to repair it a little bit.
You probably should assume that you're going to have to do something, right?
Exactly, and typically, I mean, I can't imagine getting into a house and not having to spend at least $5,000. I mean, just paint and fixtures alone, really.
You get in and out for $5,000, you're doing
real well.
Good.
Yeah. I mean, if you can get into a decent home and you don't have to do the flooring, and you don't have, if you can just get in, paint, and do some fixtures, you can get in and out for about $5,000.
Right.
So let's just say that that's where you're going to be. Let's just call it 10. 10 between your attorney fees and your repairs. I mean, that seems
at least.
reasonable.
Yeah, that sounds
Cool. Yeah, I go with that. Again, this is going to be, you need to know your numbers when you're looking at
So you're 30 out of pocket then.
30 out of pocket. I'm making 625. If I multiply that by 12, 6,250.
Can you do that quickly?
Yeah, it's a system you do at 112.
I'll help us out. So 625 times 12. That's 7,500. Yeah, you're too quick.
It's just you break down number. It's a whole mathematical thing. Anyway, $7,500. If I'm all in for 30, and I'm making $7,500 a year, I'm pretty sure that's going to put me at 25%.
You said $30,000.
$30,000 cash down, divided by 7,500.
I get 4.
That's 25%.
Okay.
Yeah. So I'm making a 25% return on my investment.
Perfect. Yeah, it's a good day then.
Now that is just your cash on cash return. The big thing that I'm into, and I've met a lot of investors and a lot of commercial brokers, and this is their world, they don't take debt reduction into account because it makes it difficult to compare apples to apples, and I get that. But now most people are going to leverage. And when you take that into account, that $400 a month you're paying, at least 100, 150 of it is going to be principal reduction for the first year. So if you just say, let's be generous, very conservative, $100. Sure. That's $1,200 extra a year. So now your 7.5 is up $1,200. So you're making a 25% cash on cash return, and then your $1,200 bumps that up, and you're at 8.7. And if you're in 30, you're sitting there at about a 30+% return on investment, right around there.
So you take into account equity that you're making, because I never have, because you can't eat it.
You can't. But if I owe you $100,000, and at the end of the year I owe you $50,000, I just made $50,000. Because the number one number, maybe, assuming the equity in the house didn't plummet and all crazy things that happen. But in general, the number one number in your life to track if you want to become wealthy is your net worth. Because when people take on debt, the people that don't understand net worth go, oh my God, I just took on a note of 80. I just assumed $80,000 in debt. Oh no. Well, if you've put $10,000 in this property, you bought it for $100, hey, maybe it's worth $125 now. And now you only own $80 on it, and you just created $25,000 worth of value, and now every year you're paying off $1,200 worth. So to me, I
totally get it. Yeah. I would, based on my experience, I'm always really cautious to go too much on the equity. It's more of like, don't think about it, don't plan on it, don't take it into account. If it's there, awesome. But I don't know. Equity plays have always gotten people in trouble.
They have,
and that's always like the concern of like you count on it too much. It's like, well, what if there is no equity? Then what? Then it's not a good deal. Like it should be. I always advocate you got to have a standalone good deal on a cash flow, and anything else on top of that. It's not that it's bad. It's going to be great, but if you're banking on the equity, right? Like so.
You nailed it. Yeah. So there's a huge difference between when I have a cash on cash return of 25%, that is a great investment.
Yeah.
I'm very happy with that.
Independent of what happens afterwards.
Exactly. Right? Then when I bring in my total return on equity, if I'm assuming that my property is going to go up in value and that we're going to rise at 5% for the next 10 years, and I project all that stuff out, and then I'm running my numbers on that, that's speculation.
Right.
That's gambling. By definition, you're gambling. It's the same thing when you buy gold. When you buy the stock Apple, you're buying a company that produces a product that creates a cash flow. You're buying a cash flow. That's an investment. If you buy gold, you're buying it at one price and hoping someday someone pays you more. That's speculation. One's an investment, one's gambling.
Well, let's bring it back to this investment then.
Yes.
So it's a good deal.
From a cash on cash standpoint, if the numbers hold out, I like this. I would start, this is my back of the pad thing. Next step I would do is I would try to lock it under contract for as low as I could get them down, because that's in your best interest to do so. And then I'd start running my numbers, and I'd want to confirm the tax. I'd want to confirm an insurance amount. I'd want to make sure that my mortgage payment I understood, and all these things. So
perfect. So let's do this. I'm going to flip a page over here on my notes, and let's not do numbers. Really quickly, what are the things that you're measuring from a cash flow perspective? So obviously you're going to be looking for gross rent, right?
Gross rent is the number one. What can I rent it for?
What are you subtracting out of that?
I'm taking off 5% for vacancy as a general rule of thumb.
That's right.
10% repair and capital expenditures, because I'm going to know everything. I'm going to know the age of the roof, the age of the systems. I'm going to know all that before I buy it. And so I will account for it. But in general, that's what I account for.
And then 10% management?
10% for property management, because while I manage it now, I won't always. The next thing is going to be, I want to confirm taxes. You can do that for free at the comfort of your home. It's all public record to see how much someone pays in property tax.
Then insurance?
Then I'm going to contact my local insurance agent, and I'm going to ask them, hey, this property, this location, can you give me an idea of what my quote would be? And then I can project that.
And then debt service, right?
And then talk to my lender, what interest rate you're going to give me, what terms you're going to give me, and then I can sit there and run all the numbers. And me personally, I really won't touch real estate unless I'm making a 20% return combined with my total return investment. That includes the debt payoff. Now, I understand what you're saying about playing with equity, but if I owe $80,000 on a property and at the end of the year I only owe $68,000, that's a boost in my net worth, because your net worth is what is your thing's worth and how much do you owe. So I take that into account. That
fair enough.
For me, that I have to hit that 20%. Cash on cash, I want 15 plus.
Okay.
That's my rule of thumb. I'm aggressive in that way. Some people are a lot more lax. I mean, I know guys in commercial world that they'll take a 5 cap, a 6 cap, which essentially means if I pay $100,000 for this, a 5 cap would be $5,000 a month in my pocket. A 6 cap would be $6,000 a month in my pocket. And so, depending on the quality of the investment, depends on what the return you should expect.
And once you have these numbers and you get a feel for it, you get to make your own benchmarks and rules. Well, all right, let's do another one.
Yeah.
Really quickly, now that we have the framework for it.
Yeah, so you've got 2 guys here that can just really rip it down. So this one's very interesting. This is 6 Blackberry Lane in Candler, North Carolina. They're asking $130,000. The size of it is 825 square feet, and it's a 3-bed, 2-bath. So we're talking there's
twin beds only.
This thing is tiny. So right there, even though it's a 3-2 and it's in Candler, this is going to affect how much rent we get, big time. I mean, I'd have a hard time seeing getting $1,000, $1,200. I mean, it'd be hard.
I'd feel like I would probably be in that $950 range.
There we go. Let's say $900. Right? So we've got $900. You want to put the 25% on it. That would be $450, $225. So you minus $225 for all that stuff. Then the taxes. The tax value is $50,000. Taxes can be nothing. I mean, no, it's
Let's
a
just call it
but still.
$500 a year again.
I would
$400,
$480, and then we're at $40 a month.
Okay.
It just makes it easier. And then we'll do the same thing with that. And so we're at $80 off, $80 a month for taxes and insurance. And then you run your numbers on it, and you come down, and you've got 900 minus 2, 305. You're at $595. Let's just call it $600 for round numbers. You're at $600. That's your profit. And you do the same thing. Hey, I'm going to borrow the money from the bank. It's going to be the same terms. I'm still would only want to be paying. Let's just say we're going to pay the same price.
Right.
So we can look at 2 different things. We're going to pay $100,000 for this. We're going to borrow. We're going to do the same thing. We're going to put 20 down. We're going to put 10 grand into it. All the same things.
So that puts us at
$400
a month.
$400
is what you said, right?
Yep. So now we're only making $200 a month. So we'll call it $2,500 a year. I know it's $2,400, but just for ease, and we're all in for $30,000. That's not good. That's a low return. You're sitting there sub 10%.
But it's a house. Whereas the other one was a double wide.
No.
Oh, this
is still a double wide.
A 800 square foot double wide?
But it's a 3-2.
I did not know that they made them that small.
I didn't either. I was blown away. Okay. That's why I said it was an interesting one.
That is crazy. Okay.
Yeah. But let's just say it isn't a double wide, because there are homes in the county that are under 1,000 square feet, that are under $150,000, that are
3-2s,
3-1s, 3-2s, 2-1s. They exist. So we could run the same thing.
What I was going to say is if it's a house, it is going to have and sustain its equity better, right?
Yes.
And so that's what I was going to ask you. If it is a house, how would that change your numbers based on our prior conversation?
So the way it would go is we talk single wides, double wides, and homes.
Single families, yeah.
So when I say homes, I mean also on-frame modulars, off-frame modulars, and site builds, because Fannie just changed the rules that said that they're all going to be appraised the same.
Okay.
So while they don't sell the same, they're going to kind of start blending. We'll just keep them in one pocket. Makes it easier. On a single wide, I'm limited in the financing I can get, and I can't do a home equity line of credit, which once you start paying down that debt that you've leveraged, a home equity line of credit is one of the greatest tools to an investor, because you can pull the money out, pay interest only, deploy it, get that capital back, put it away, and it's your own private money bank at reasonable interest rates. It's a huge tool for investors once you get the machine going. Double wides you can get traditional financing for, but again, no home equity line of credit. And a double wide, if you want to get traditional lending, you have to have a piece of land to go with it, which obviously a rental property in a park is a risky thing for you because at any moment the landlord of the park could raise your lot rent and it throws your numbers out of whack. But if it comes with land, a single wide with land, you're stuck to a few lenders. Vanderbilt, 21st Mortgage, there are a few lenders that will do that. Regular bank will touch a double wide if it has a permanent foundation and it's approved by a structural engineer and you've turned the title over to the county. They'll touch it, but you can't do home equity line credit. But you can do cash out refis, you can mortgage
There
purchases.
are other things you can do.
There are things you can do. Then site-built homes have all of the great things that you can do.
Okay. Well, we've run numbers a couple of times, and I know you had one more property, but kind of wanted to wrap things up and maybe not do a deal review specific, but maybe talk about some common pitfalls you see when people analyze numbers. Where do people get too optimistic? Where do people not have enough cautiousness when they're running numbers? When
gross rent.
You see, as far as people
gross rent
expect to get more than what they can.
Yeah.
That's easy to do right now, right? Because everybody's like, things are renting so fast, things are renting so high, et cetera.
Yeah.
Like I know for us, we've had to bring our rents down this year to match market.
Yeah.
So I don't know if you've seen the same.
I just haven't raised my rents other than if someone leaves and they were way below market. When they leave, I bring them up close to market. But I'm relatively flexible in that. And this brings us to a great point. It's a great question. If you can get $1,000 a month in rent, if that is what you could get that, but that's at the max of what the market will bear for you. Every year when that lease comes up, they're looking for a new place to live because they realize they're paying max rent, and they could go maybe they could find something better for the same rent. Turnover is incredibly costly
hate it
because you always have to repair the unit every time. I don't care how awesome the tenant was, you're gonna have to repair it, and then you lose the time that they're not in there. You lose the time trying to find a new person. And if you have a good person in there, they're a challenge to find because a good tenant and a bad tenant are going to dictate whether you like being a landlord or not.
Question.
Yes.
True or false?
Sure.
There's no such thing as bad tenants. There's just lazy landlords.
Ooh, that is a good one, but I'm going to go ahead and say false.
Interesting.
Yeah, because I think if you're a lazy landlord, you will have a much higher ratio of having nothing but bad tenants. But if you're a great landlord, you can still end up with a bad tenant. It just happens. You can do all your due diligence. I run background checks, credit checks. I call references. I look at their paychecks. I call their employer. I do all of that. But it still happens because someone might be a couple and then they split up and then one moves out. And now you got one guy trying to support a rent he can't afford. And he starts to fall behind and he comes up. It just, you need to be, one of the biggest things is I like a renter with a credit score above 660 because they do not want an eviction on their credit report. If you have a credit score above 660, you will leave rather than going through the eviction process because you don't want that on your record, your credit report, because you care.
Right.
So that's one of my general rule of thumbs. A big tip that someone told me and I've never forgotten is if you meet someone who come look at one of your renters, go to their car.
Yeah.
If their car is full of trash and it's just dirty as heck, that's exactly what they're going to do with your unit.
Right.
That's one of my favorite little not spoken kind of unwritten rules that can really be assistant.
Anything else number-wise that we should be aware of or take into consideration? I mean, I know we've covered a lot, but I think,
to hit your numbers, you really have to, I like the saying, don't expect what you don't inspect. So if you're going to buy this property and you're like, oh, it's only going to cost this, if you haven't had at least 2 or 3 bids in there saying, we can do this for this, you don't know. And if you're not going to confirm with your insurance agent how much the insurance is going to be, if you don't confirm what the tax bill is, if you don't confirm these informations, especially the gross rent, you really need to call some people that know that area, that market, and they have experience and say, what can I expect to get for rent on this thing? Call a couple of property management companies. Say, what would you rent it out for? Be wary. If you call 4, be wary of the one that's way higher than the rest of them. You know, like be conservative and be surprised. I'd rather assume I could get 1,000 and be surprised when someone said, when I have a couple people jockeying for it and someone says, well, I'll pay $1,100. I'd like that to be a surprise and run my numbers off that. So that's a big one.
Absolutely. Well, Keith, thank you so much for taking the time to come on here again.
I love coming in here.
Yeah, we'll have to do another. It's always enjoyable for sure. So, there you guys have it. Just run your numbers. If you are listening to this on the podcast, you can go back and watch this on YouTube. We're going to have some of these numbers on the screen so you can take notes. But if just hopefully this was helpful for you guys. Go out, find some houses. Now you know what the math looks like. Contact Keith if you have questions. Yeah, I think I can say that, right?
Absolutely.
Okay. How does somebody contact you with questions then?
They can reach me at my cell phone, which is 828-808-3288, or they can send me an email, which is keithprescott@kw.com. If you want to get into investing and you haven't done it,
listen to this podcast.
Listen to this podcast. Always follow up with this podcast. But if you're going to find deals that are on market, find a good investing broker who owns investments and understands them, like myself. They're essentially free to you because some brokers are going to get paid when that house is bought. It might as well be the guy that's knowledgeable and helping you through the whole process. So it's essentially free to you. And then we brought 2 books. I just brought 2 books in. One is The ABCs of Real Estate Investing by Ken McElroy. It's from the Rich Dad, Poor Dad kind of Robert Kiyosaki thing. It's a really good book for some information. And then you have Gary Keller from Keller Williams put out The Millionaire Real Estate Investor. It's another good thing. If you read both of those books, it gives you a really good foundation of information to build on.
Did you know that one of the featured people here is a local?
Yep.
Which I think is pretty cool. So it can be done anywhere. So there you have it, guys. Thanks for tuning in to another episode with Keith. He had another episode, came out a couple weeks ago, so go back, check that one out if you're interested on the personal finances. Once you got that ironed out, listen to this one again, get the rental journey started for you. And reach out to Keith if you guys have any questions. We'll see you all next week.
Thanks so much, Rodrigo.
Take care. Bye.